high. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we explore the story behind key banking sector developments. It is the 20th of July 2023. I'm Swapnil Joglekar, and this is what we have lined up for you today. First up, our cover story will discuss if the worst is over on the NPA front. In bankers' view, Mahesh Misra, the CEO of India Mortgage Guarantee Corporation, talks about the impact of the HDFC Bank merger. In Banking for You, we'll tell you what internationalization of the rupee is. Then our consulting editor Tamal Bandopadhyay joins us to share his views on tomatoflation and more. At the show's end, we share the results of last week's poll and the question for this week. All this in today's edition of the Business Standard Banking Show. The Reserve Bank of India's latest financial stability report had a piece of good news. GNPAs or gross NPAs had fallen to a decade low. GNPA refers to a loan on which the borrower hasn't paid any amount in the last 90 days. But the central bank's former governor, C. Rangarajan, argues that new NPAs are actually rising. So is the worst of NPAs truly behind us? My colleague Raghu Mohan tries to dig up the truth.
The banking sector is in a sweet spot, with sustained growth in bank credit, low levels of non-performing assets, and adequate capital. Reserve Bank of India Governor Shaktikanta Das has said that both banking and corporate sector balance sheets have been strengthened, thereby engendering a twin balance sheet advantage for growth. A column in Business Line jointly authored by former RBI Governor C. Rangarajan and B. Sambamurthy, former director and CEO IDRBT, points to the dramatic reduction in the gross NPAs of banks. In FY18, this ratio was as high as 11.2%, raising concerns on the stability of the banking system. This has come down to 3.9%. After reaching a peak of 10.3 trillion rupees in FY18, GNPAs came down to 7.4 trillion rupees in FY22. GNPAs as a percentage of credit came down from 11.2% in FY18 to 4.3% in FY22, going down further to 3.9% in FY23. The duo also call attention to the substantial write-off of NPAs by banks year after year. The total write-off since 2016-17 amounts to around 10 trillion rupees. The Financial Stability Report of June 2023 observes that the write-off to GNPA ratio, which had been declining consecutively through FY21 and FY22, rose in FY23 due to large write-offs by private banks. In itself, write-offs are not bad. After all, banks can do it only if their bottom line support it. Adding to FSR, June 2023, banks' GNPA ratio continued its downward trend and fell to a decadal low of 3.9% in FY23, with net NPAs at 1%. Yet you can't help but raise the question, are fresh NPAs lurking around the corner?
We know that the banking system NPAs are clearly on a downtrend over the last few years. And this is clearly, happening after the peak that we saw after the asset quality review, which led to a spurt of large corporate NPAs in the banking sector. After that, and when the banking sector NPAs had actually breached 10 lakh crores NPAs, there has been a downtrend from that peak. And if you look at the numbers, it has not been really only because of recoveries. It has also been because of significant write-offs that particularly the public sector banks have done. As far as the current NPA situation is concerned, the numbers tell us that the gross NPAs have for the system as a whole have come down to around 4%. Uh, where the issue today is that there is a very rapid growth in unsecured loans. For example, unsecured loans to retail individuals and unsecured loans also to small businesses. That is where we believe that there are risks, although it is yet to show up properly in numbers. But we should also understand that there are many restructured loans as well, where these loans need to perform over the next 1 year or so.
Is retail a problem area? Of late, Mint Road has sought information on the retail book of banks, especially unsecured credit. FSR June 2023 calls attention to retail loans. They grew at a CAGR of 24.8% between FY21 and 23. This was almost double the CAGR for advances in the same period. The composition of secured and unsecured advances has changed during this period. Unsecured retail loans increased from 22.9% to 25.2%, and secured loans declined from 77.1% to 74.8%. The RBI's report on trend and progress of banking made an interesting observation. In recent years, Indian banks appear to have displayed herding behavior in diverting lending away from the industrial sector towards retail loans. Empirical evidence suggests that a buildup of concentration in retail loans may become a source of system risk, said the report.
As they say, if a bank's balance sheet supports it, write-offs are not bad per se. Talking of the balance sheet, the combined books of HDFC and HDFC Bank catapulted the merged entity to be the 7th most valued lender globally. But how is this merger impacting the home loan business? Raghu Mohan caught up with Mahesh Misra, who's the CEO of India's only mortgage guarantee company, to find it out.
Welcome to the BS Banking Show, Mr. Mishra. My first question is, how will the HDFC Bank, HDFC Limited merger play out on the home loan business?
So the merger is definitely very exciting for the home loan industry because it is a merger of two giant companies. We expect that HDFC Bank has a very ambitious DNA, and we now expect that to translate into higher appetite for market share because HDFC has been in the number 2 spot for the last few years. So we expect the race for the top spot between SBI and HDFC Bank now to hot up. But what this will also mean is that the banking sector will acquire a disproportionate share of the mortgage industry. As of now, there were only two housing finance companies, HDFC Limited and LIC Housing, with a balance sheet of greater than 1 lakh crores. So now nearly 70 to 75% of originations for the housing loan segment will be with the banks. Now, what this means is most banks typically tend to focus on the top tier cities, on loans greater than 20, 25 lakhs and so on. Housing finance companies, especially affordable housing finance companies, they play a very critical role in the larger housing ecosystem by going to unbanked geographies, by going to unbanked customers, deeper geographies, unbanked customers, and so on. So I believe that for the affordable housing focus to kind of sharpen, it is imperative that some of the housing finance companies now quickly build scale.
Are you then suggesting we need more HFC players?
We may not need more HFC players. In the last 5 to 7 years, nearly we have more than 100 registered HFCs. What we need is more HFC players with scale. If you see the current HFCs, then many large industrial houses have HFCs which have been operational for the last several years. Second, almost all large private equity players have housing finance investments. So capital for housing finance companies will not be a challenge in the immediate future. What is required is scale. and especially in the housing finance companies that are backed by large industrial houses, the access to capital along with the access to parent company rating is an added advantage. So they are even able to borrow cheap. So what we will need is a couple of housing finance companies to step in and build scale and quickly weave their way into the top 5-6 slot. Some of this is a consequence of DHFL and India Bulls slowing down. But now we see that the DHFL part, at least their new owners are very ambitious, aggressive, and systematic in their growth plans. We will need a couple of other such housing finance companies to step up on the ambition part.
Yeah, but even when HDFC Limited was around, it was an outlier in terms of size. Why didn't the other HFCs gain in size? How do you explain that?
No, the other HFCs did not gain in scale. If you look at the scenario, say 5 years back, we had 4 or 5 housing finance companies that were large scale. You had HDFC Limited, we had LIC Housing, we also had DHFL, we had India Bulls, we had PNB Housing. All of them were originating upwards of 1,000, 2,000 crores a month. What has happened is that those with access to low cost of funds and with the liquidity challenges that came post-COVID, the larger players got a disproportionate advantage. So now is the time for the smaller to mid-sized players to rebuild and scale.
Are you raising a question on the HFC model itself?
No, I'm not raising a question on the HFC model. I'm saying that it is imperative for the HFCs to now build scale because the model has been proven in the past. If you even look at DHFL's model when they were building a retail book, the retail book was not really troublesome. So HFCs have demonstrated that it is possible to build a large book along with affordable lending. Somewhere in the aftermath of COVID, we believe that building scale is taking time. Self-employed businesses are facing the struggle, and there has been an increased propensity to lend to salaried borrowers. If you look at all the large players, if you look at State Bank, if you look at HDFC Limited, the proportion of salaried borrowers in their origination mix is very high. And somewhere, we believe that we can play an important role in this. If you see our portfolio of 20,000 crores, we have now nearly 35% of our origination now is in rural and semi-urban areas. I believe that if we look at the housing finance industry for the next 5 years, currently the industry is at 33 lakh crores. It is expected to go to 50 lakh crores by FY 47. If you see the next 20 years of growth, I believe the first thing has to be that public sector banks have to get more focused towards affordable lending. Public sector banks currently contribute 40% of the housing finance origination, out of which if you take away State Bank of India, the others put together are about 20%. But all of them are operating in the ticket size of 25 to 35 lakhs. So for the industry to grow and for the dependence to go away from 4 or 5 players, and more importantly to drive financial inclusion, step one has to be public sector banks have to go into deeper geographies and do more inclusive lending. Second, housing finance companies, now that they have reasonable access to capital, should be demonstrating ambition to build scale because it has been shown in the past. So the need to build scale is imperative. We also believe that once the securitization committee recommendations and a couple of other initiatives that the regulator is taking to promote securitization take place, it will help smaller housing finance companies operate with greater ease because they are the ones who will feel the pinch to capital. So once we have securitization back as a vehicle of liquidity, I think that will also help. Fourth is for the housing finance companies, co-lending initiatives are very encouraging, but everyone has so far taken only baby steps. Once we see some co-lending taking shape in a more fruitful manner, I think that will help the industry.
Mr. Mishra, it was wonderful having you on the BS Banking Show. We look forward to having you again sometime soon.
Thank you, Raghu. Always a pleasure talking.
From India's changing housing finance landscape, let's move to the rupee and its internationalization. How would you like if you could pay for your import order in rupees and not worry about dollar fluctuations? This may become a reality if the RBI panel's recommendation of internationalizing the rupee gets going. But what is it? And what are the benefits and challenges? Manoj Saha explains.
One of the immediate triggers for the RBI to take steps to make the rupee popular beyond boundaries is the Russia-Ukraine war, which started in February 2022 and is still continuing. The resultant sanctions following the Russian invasion of Ukraine made many countries wary of the price they may have to pay if they are subjected to similar sanctions by the West. The thought process, however, for such a move predates the war in Europe. The 2020-21 Currency and Finance Report of RBI said, looking ahead, the emergence of INR as an international currency appears inevitable. In July last year, the RBI allowed bilateral trade settlement in the Indian rupee, mainly aimed at buying Russian oil with the Indian rupee, a move that has been interpreted as the first step towards making the rupee global. Last week, Indian and UAE governments agreed to settle trade in local currencies, yet another step towards that direction. RBI had set up an interdepartmental group to review the position of the Indian rupee as an international currency and chart a roadmap for the internationalization of the rupee. The IDG report was put up in the public domain earlier this month. The IDG report notes, the Indian rupee has the potential to become an internationalized currency as India is one of the fastest growing countries and has shown remarkable resilience even in the face of major headwinds. Importantly, the IDG said that capital account convertibility is not a precondition for internationalizing the rupee, or vice versa, and that the current level of capital account convertibility gives enough room for initiating steps towards internationalization. India has made appreciable progress in capital account convertibility, global value chain integration, setting up Gift City, etc. The higher usage of INR in invoicing and settlement of international trade and capital account transactions will give the rupee a progressively international presence. Currency internationalization has been described as the international extension of a national currency's basic functions of serving as a unit of account, medium of exchange, and store of value. In other words, the internationalization of a currency is an expression of its external credibility as the economy integrates globally. The US dollar is said to enjoy an exorbitant privilege among global currencies. Among the benefits, the internationalization of its currency allows the country's exporters and importers to limit exchange rate risk. At the same time, there are certain challenges to the internationalization of a currency, as it may result in the potential increase in volatility of its exchange rate in the initial stages. IDG concluded that the benefits of internationalization in terms of limited exchange rate risk, lower cost of capital due to better access to international financial markets, high seniorage benefits, and reduced requirements of foreign exchange reserves far outweigh the costs.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
So from banks and the rupee, let's now move to bankers, more specifically public sector bankers. In our expert take today, Tamal Bandyopadhyay discusses why an industry-wide wage pact may not be best for public sector banks. I also asked him whether tomatoes had upset RBI's inflation arithmetic. Here's the chat. Hello Tamal and welcome back to the Business Standard Banking Show. In this week's column, which is aptly titled Pay Them Well, Give Them a Break on Saturdays, you argue that an industry-wide wage pact may not be the best thing. Why do you say so?
No, it's certainly, it has been. I stand by what I have written. It's now what 1960s, 66 before nationalization. This wage pact started, and as we speak, 2023, the profile of the banks have changed. The banks are treating themselves like tech companies. The expertise that required from the employees and the officers, the workmen and the officers, are very different than what it was. What happened, the problem with the industry-wide wage pact is this: you go by the ability of the weaker banks.
because it's the benchmark, everything is it's all applicable to all banks. So you don't go by the better banks who are more profitable and who can afford more, because if you do that, then the weaker banks will not be able to match that. So that's the key issue with this. Of course, as we speak, banking sector is sort of to use a cliche, is in pink of health. Public sector banks also I'm talking about. They are pretty well capitalized. The NPAs are pretty low. And if you see fiscal year 2023, their combined net profit rose beyond 1 trillion. So it's very good time. But the key question is, isn't the time actually to look at things in a different way? If not at all, if you don't want to, break it. My understanding is this: there have been in the past occasions when a few banks wanted to break away, but ultimately it did not happen. The IBA, the premier bankers body, and the trade unions, they discuss and they come up with this 15% kind of addition they get. I mean, the raise they get, etc. But in this situation, can you actually compete with the private banks? Because what we are saying, despite consolidation, public sector banks' incremental share in both deposits and loans, you will see it's been going down. So how do you attract talent, particularly if you see at a fairly senior level? At the junior level, when a so-called provisionary officer starts his or her career in a public sector bank, he or she is much better looked after than private banks, apart from the security of job. But as they go up, from chief manager onwards, you see the gap between public and private sector banks widens, and of course it widens too much at the most senior level for the CEO. But that's a separate story altogether, because their salaries are linked to the IAS cadre. I mean, these guys are dealing with money, the bankers, and the bureaucrat job are very different. Why do you link that? That's a separate story altogether. But even for the workmen, that is the clerical staff and the executives, the officers, I think we need to have a different approach, particularly at this among the officers, at the relatively senior level. You need to pay them better. And probably other part is this: why don't you shift to the CTC concept, that the cost to company concept? Because what we prima facie see, the salary that's at every level in the public sector bank, it's not exactly everything. In addition to that, they get many other benefits. So why don't you monetize everything, be transparent, and be competitive? That's all. Now, once you do that, at the same time, the recruitment process, etc., also needs to change. I mean, you can't just give them more money, at the same more security, everything else you can't give them on a platter. So actually, you need to approach the thing in a HR approach has to be different, right from the recruitment policy to the payment. That's the argument I have made if you want to make public sector banks competitive.
Right. So, Tamal, as you say, the profile of banks has changed and they are in pink of health. Maybe this is the right time to actually do this. But is everything really fine? Of course, I'm drawing your attention to Shaktikanta Das, the central bank governor's meeting with the head of public and private sector banks, and him asking them to focus on corporate governance. So is there something here below the surface that we should be worried about?
Yes, if not worried, I think when the banks are doing pretty well, Reserve Bank of India has adopted the right approach. It's time to take a close look at the corporate governance. You see the quality of boards, that's one part of it, and the other part of it is how independent are they, particularly in the private banks. Not in all private banks, but in some of the private banks, you will find that the board of directors, the so-called independent directors, are not actually independent. It's the CEO who has the last word. Now, public sector banks have other different issues altogether, because they are primarily owned by the government, and the government as a dominant shareholder, does certain things which are again not exactly in tune with the corporate governance. So the issues are different both in public and private. In public sector, the origin of the issue is primarily the government ownership. As you all know, that banks are subjected to the dual regulations, actually one by Reserve Bank of India and one by the dominant shareholder government. I think it should end. There's a governance issue there. And private banks, as far as private banks are concerned, I think it's a quality of board. That's the worry of the Reserve Bank of India.
And now, staying on the topic of RBI, I have to ask you this question. Has tomato soured RBI's inflation arithmetic?
Yes, sort of. I could say that the food inflation again is becoming an issue, as you said. The June inflation is higher than what it was May, and analyst perception is this: in July and August, the inflation will go up further. Now, if you see the last RBI policy, RBI is pretty cautious. It stuck to its status quo and saying that whatever needs to be done, we'll continue to do it. It did not even change the stance. And there was a very minor change, I think 10 basis point change in its inflation outlook. Now, as we speak, Reserve Bank of India has been preparing for the MPC next meeting, which will happen in August. And if you see the last bulletin, which is a June bulletin that has come in July, towards the conclusion part, the bulletin says this clearly we are keeping a very close watch on inflation. In the fight against inflation is not yet over.
So it seems the pause will continue for long. Thank you, Tamal, for joining us. So Tamal says that to make PSBs competitive, everything from recruitment to pay will have to change. He also says that the RBI has been right in being cautious when the sector seems to be doing so well. Last week, we asked whether you had signed the renewed bank locker agreement. 36% of our respondents said yes, while 64% said no, they haven't. Now, imagine a life with all the benefits of physical rupee without any hassles. Would you like to experience that? The RBI sure hopes so. It has set a target of 1 million e-rupee transactions by the end of 2023, up from 5,000 to 10,000 currently. This week, we want to ask you whether you would like to try the e-rupee. Our poll is open from today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We'll be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.